Hello and welcome to NDTV Profit. You are watching IPO Adda, and my company in focus today is Mamata Machinery. It's an Ahmedabad based company which is into manufacturing of machines for plastic and pouch, which are mainly used in the F&B and the FMCG sector. The company's IPO is opening on December 19th, closes on December 23rd, price between 230 to 243 rupees per share. It's an OFS for nearly 179 crores, and that gives a value of nearly 600 crores to the company. And joining me today is Apurva Kane, who is the CEO of the company. Mr. Kane, thank you very much for joining us on NDTV Profit. To begin with, sir, give us a sense of the business that you are in and the business model that you work on.
Mamata Machinery Limited is based out of Ahmedabad, Gujarat. We are a company that has been manufacturing machinery for plastic industry, mostly bag making and pouch making machines since 1988-89. So we have been doing that for more than 35 years. We also manufacture co-extrusion blown film lines, which is to convert polymers into films. And we also manufacture horizontal form field seal machines and vertical form field seal machines, primarily focused on food packaging in India. 70% of our top line comes from export. We export to more than 75 countries around the world. And we have an installation base of 4,500 machines.
Give us a sense of your profit and loss P&L table, because I was looking at FY24, it had a top line of 236 crores, but in Q1 it's just 27 crores. So is there a lumpiness in the revenue that comes in for you as well?
We are in machinery building business, and machinery building business, because of the values involved, particularly in extrusion, it tends to be lumpy at times, because if a customer's project is delayed or if their loans are not approved, you could have a machine with you, and if the financial year changes, then that particular sale is captured in the next financial year. So that can happen, particularly for high value machines. But as far as low value machines are concerned, that is a very steady business, and we don't really have lumpiness there.
What explains the kind of quarterly numbers that have come in? Because just to understand this, because 27 crores in top line in Q1, so was there an issue with respect to shifting of some of the orders to the next quarter? How is it actually?
Yeah, so basically in capital equipment business, H1 is always slower than H2. If we look at last 3 years, on an average, what you would see is 35% of the top line is generated in H1, and 65% of the top line is generated in H2. And that has been a pattern for many years. That is probably nature of the beast, but that is how things work in capital equipment business.
And is there a way you can normalize this anomaly, or that the lumpiness that comes into revenues and profitability on a quarterly basis?
I'm sorry I lost you there.
Yeah,
Could you please repeat the question?
My question was, is there a way you can normalize this revenue going forward, this lumpiness which is coming between Q1, Q2 and the second half of the year?
Well, Mamata Machinery has always based its growth on innovation of products, and also it has based its growth by introducing its product to newer markets. And since we continue to follow that proven model, we don't see issue as far as growth is concerned moving forward.
What is the kind of order book that you're sitting on at this point in time, since you said a lot of lumpiness means the revenue concentration comes in the second half of the year?
We are sitting on an order book of about 180 crores.
Okay, and that has to be executed by the end of this financial year.
We should be somewhere around 300 crores by end of the year.
Okay. Also, give us when you said 70% of your revenues comes from exports. Give us the exports market that you sell your product to, and how big are these markets or growth opportunities there?
Nearly. See, we have a 100% owned subsidiary called Mamata USA in USA since 2004, and that contributes nearly 30% to the top line. 30% is contributed by approximately by Indian market, and then balance 40% comes from what we call as rest of the world. That includes Middle East, Africa, and Europe.
Okay. I was looking at your RHP.
So it's well diversified. It's like.
So I was looking at your RHP and it, yeah, I was saying I was looking at your RHP and your revenue mix for country wise. Canada and Mexico are some of the countries where you had good sales in FY24, but it wasn't showing up. So what is the kind of exposure that you have to countries like Canada and Mexico?
So Canada and Mexico is serviced by our office and in Florida through Mamata USA. So when I say 30% is contributed by Mamata USA, that also includes sales to Canada and Mexico.
Sir, this is an OFS for nearly 179 crores. You are looking at global markets. You don't need any growth capital?
We are a debt-free company, and we had, as of FY24 closing, we had nearly 48 crores cash on our balance sheet. So, for our expansion plans as such, we do not need additional capital as of now. The reason for OFS is because we want to unlock the value of the company for promoters and the new shareholders who will be joining us during the IPO.
You have a very high inventory level, especially in Q1 you had only 880 days of inventory levels. Is this a conscious effort to have a very high inventory level in the first half of the year?
Yes, that happens from year to year because there is a lot of goods that are shipped out in March, but they are not captured in a given year's sales because they are goods in transit, and that appears as inventory on books.
And how do you recognize those goods? Are they recognized as revenues, or the revenue gets pushed to the next year?
They're basically, it's a sale that it is basically deferred sales.
Okay.
To next year.
Also, give us a sense of the kind of cash flows that you see in your operations, because for FY24 it had a negative. You had a negative cash flow from operations. Given the kind of high inventory levels that you're carrying and the chunkiness in the revenues that comes in, how do you see the cash flows going in from coming in from operations?
In terms of cash flow, we are a cash flow positive company. however, it appears as a negative cash flow because of certain accounting standards and grouping, because we had these FDs worth 48 crores as on 24th of as of FY24, and they appear as long-term assets. So it is moved from cash flow to another group, and that's why you see negative cash flow. Actually, it's not.
Okay. Give me a sense of the kind of profile you have of the customers. You said your top 5 customers in Q1 is around 60%, and in and top 10 is around 75%. That has that's compared to nearly 21% for top 5 in FY24 and 31% in for top 10. So give me a profile of the customers that normally you service, and these are these repeat customers, or they are new customers?
In machinery business, normally you don't have a constant list of top 10 customers. The top 10 customer lists will change every year because you will have new customers. As a company, our repeat business is approximately 50 to 55% of our top line, but the same customers do not appear on the list in every financial year. So it keeps on changing.
And the component with respect to attachment spares and all, that's also a big component of your sales. Does it also does it vary from year to year? Because in Q1 it seems to be a very high percentage.
The attachment requirements are based on the opportunities that our customers have. Spares is something that is required for their own maintenance from time to time, and it is growing, but it is growing at a low pace. I think it's about 7% of our top line in FY24.
Mr. Khan, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit. Your IPO is opening on December 19th, closes on December 23rd, price between 230 to 243 rupees per share. It's an OFS for 1979 crores. That gives the company a value of nearly 600 crores at the top end of the price band. Thank you for joining us today.